Hi, good evening, everybody. Ethan here from Investing Note. Hope everybody is doing well. Okay, we see a lot of people streaming in. Right, awesome. Okay, just let me do a quick check if we're streaming to YouTube. Okay, awesome. Right, let me just share my screen. Okay, let's just give our audiences a little bit of 1 or 2 minutes to actually stroll in. To join this webinar. And today, I'm very happy to have two special guests on our webinar series, right? Of course, the first special speaker, Mr. Adrian Chu, right? Vice President at CSOP Asset Management. Adrian, you can say hi.
Hello. Hi, good evening.
Yep, we can all hear you.
Yes.
Awesome.
Wonderful backdrop for Singapore CBD area, yes.
Yeah,
it's a fitting theme.
Nice. It doesn't look that real though, but
really?
It's real, right?
Yes, it is. Yeah. I'm in office today, yes.
Okay, awesome. Next, of course, we have Mr. Chua Su Tye, right? Head of REITs Research at Maybank Investment Banking Group. Hi, everyone. Su Tye, how are you?
Yeah, great. Hi, everyone. Thanks for joining us today.
Okay, awesome. And now, of course, myself, I'm Ethan, right? COO at Investing Note. So today's theme, of course, we're going to have this fireside chat. It's all about the reopening of optimism of S-REITs in Singapore. All right. Of course, mentioned earlier, Mr. Adrian, he's the Vice President at CSOP Asset Management. I think his profile is there, pretty long, and he's probably, very experienced in this field. And we have done many previous webinars together before. Okay, and of course, Mr. Chua Su Tye, Head of REITs Research, right? Very specific there, right? From Maybank Investment Banking Group, right? And Su Tye has 15 years of equity research experience and was previously from CLSA and Credit Suisse. Okay, so speakers profile are there. Let's move on to the disclaimer first. Of course, this webinar, it's for educational purposes. All right, so disclaimer there, the usual stuff. All right, so let's dive down right into it, right? Of course, we are seeing right now, many people are actually going traveling because cross-border travel restrictions have finally been lifted after, close to 2.5 years, right? I myself also are looking at traveling, right? And as you can see, in Singapore itself, we also have a lot of those safe distancing restrictions being substantially eased, right? So we can actually expect the economy to recover. But today's topic is actually about REITs, right? So I would like to get our speakers' views, right? Can we share that same optimism for REITs? Su Tye, I pass the time to you.
Thanks, Ethan. So yes, I think we can. Singapore is now trying to execute what is already being seen in certain developed markets, treating COVID-19 as an endemic. So there was a slew of loosening measures that were announced on the 24th of March. I think the relevant ones at first are going to be an increase in dining group size from 5 to 10 packs, and also the consumption of alcohol being allowed after 10:30 p.m. We expect that both of these will directly boost sales for F&B tenants. F&B tenants make up on average about a third of gross rental income for the retail REITs. So you can see in the slides that retail sales had already recovered in 2021 after 3 years of decline. Full year growth, 11%, with a rebound helped by a year-end shopping spree as retail sales moved up 7% year-on-year in December, picked up from 2% year-on-year in November 2021. So for 2022, the pre-Chinese New Year spending took place mainly in January. So comparing the performance for 2 months of festivity, so January and February, I think I saw the number, it was retail sales moving up about 5% year-on-year. So we will expect this upwards trajectory to strengthen into the second half of this year. On the right-hand side, you can see online sales. They surged during the pandemic. They were about 14% of total sales in February this year. I think expected to grow by close to double digits this year. So on the next slide, you can see the retail REITs themselves reported resilient occupancies in the fourth quarter of last year. At the same time, their tenant sales improved further. They improved ahead of shopper traffic with the easing of dining in restrictions and of course seasonality in the fourth quarter. Suburban malls continued to outperform downtown malls. Tenant sales for Fraser Centrepoint Trust recovering to 100% to 106% of pre-COVID levels. Shopper traffic is up to 55 to 65%. So you can see this chart, I took it from CICT. They reported tenant sales in the month of December 2021 that were stronger at 85 to 105% of 2019 levels. This compares to 77 to 96% for the full year of 2021. Also, this continued to track ahead of shopper traffic, which is at 55 to 65%. So retailer sentiment has already started to improve, and we see room for recovery to strengthen with a further easing of capacities. I want to make a point that VivoCity's recovery was slower. So tenant sales at nearly 90% of pre-COVID levels. That's due to limitations on large-scale sales events, the lifting of restriction on use of atrium space in malls for revenue generation. That was just announced on the 18th of March. That's going to be a big plus for MCT. It will mean that metrics will be better in its FY23. On the next slide, if we just observe the supply outlook, then I think it remains very much constrained. That's 1.2 million square feet from 2022 to 2024, or 0.4 million square feet per year. That's comparing with an average completion of about 800,000 square feet in the last 4 years. So we expect reversions to improve this year as tenant sales gain traction. We expect suburban malls to remain resilient. So reversions for FCT, that's on the right, will be low positive single digit this year, while we see downtown malls as better leverage to further easing of capacity restrictions and also lifting of office capacity limits. That's from 50% since start of this year, and then now we have 75% of those who can work from home being able to return to the office. On the next slide, we move on to hospitality. Now we saw that the gross lettings for hotels in Singapore in 2021 still depressed, 30 to 40% of pre-pandemic levels. That's because border closures kept visitor arrivals at about 300,000 last year, comparing to 19.1 million in 2019. Now, Singapore had in November last year progressively reopened its borders, establishment of new vaccinated travel lanes, facilitating higher visitor arrivals. Now, with the easing of cross-border travel restrictions, we expect visitor numbers to pick up. So while room occupancies were primarily supported by demand from government isolation contracts, RevPAR recovery, as you can see on the right-hand side, picked up pace in the fourth quarter with the opening of the VTLs. So looking ahead, I think the pace of tourism recovery will depend largely on visitors from China, visitors from India, Indonesia, Malaysia, Australia, which together accounted for 55% of arrivals in 2019. So tourist arrivals worldwide could increase by 30 to 70% year on year in 2022. They are expected to return to pre-pandemic levels at the earliest in 2024. Now that's according to the World Tourism Organization. So we believe the outlook across markets very much uneven, even though we are seeing the effects of the pandemic being better controlled globally. Now we also have heightened security concerns brought about by the ongoing Russia-Ukraine conflict. So on the next slide, you can see we expect RevPARs to recover off a low base, but visibility low, especially in the first half of this year as demand from government business tapers off. And then you also have competition for leisure and corporate travel, which will intensify. So on the right-hand side, you see the supply outlook is benign. So expected to go up around 4,660 rooms. That's averaging 3.3% per year over the next 3 years, with the majority, about 80% of this, concentrated in the luxury upscale segment. I wanted to bring in this point since we are here on hospitality, that Ascott Residence Trust, City Development, CDL Hospitality Trust, they're pivoted to more stable income assets of purpose-built student accommodation, or PBSA for short, rental housing, and also build-to-rent properties amid the slow RevPAR recovery. Ascott Residence Trust particularly has achieved strong growth momentum. It's raised a target allocation in longer stay accommodation to 25% to 30% of the AUM. That's from 15 to 20%. This is one of the stocks we like within hospitality. So across the sub-sectors, then we are most bullish on office in particular. So maybe I can share some slides with you on the next slide, which is, you can see leasing demand driven by new and relocation demand. It picked up on improving sentiment in the second half of last year. It's driven by new demand from tech and also expansion by asset, wealth management sector occupiers for large scale availabilities in the core CBD. Now, these generated 52% of last year's leasing volume. It overshadowed the space rationalization by some companies adopting hybrid work arrangements, therefore resulting in positive net absorption. So in the CBD, many tech firms have their footprints in Grade A buildings with large floor plates around 30,000 square feet. Red Hat occupies 60,000 square feet in Capita Spring. Capita Spring, as we know, received TOP at the end of last year. LinkedIn expanded at MBSC Tower 2. Twitter has leased a floor at Capita Green. TikTok, 100,000 square feet at One Raffles Quay South Tower. ByteDance occupying 60,000 square feet over 2 floors at Boko Tower. And Gojek recently relocating from Exeter Tower to occupy 24,000 square feet at Suntec Tower 5. So committed occupancy climbed in the fourth quarter of last year. As you can see on the right-hand side at Asia Square Tower 2, due to rapid backfilling of vacancies, and also Capita Spring. And we look at Suntec Singapore office occupancy, it also increased quarter on quarter. On to the next slide, I wanted to show this chart that shows Grade A office rents on the left-hand axis, and then island-wide vacancy, which I've inverted for you on the right-hand side. So you can see there's a very strong correlation between the two. Fourth quarter 2021 vacancy rate was 6.3%. That's versus 6.8% in the third quarter of last year. So this was 4.5% in the fourth quarter of 2019. And this was 3.8% in the fourth quarter of 2014. So there is room for vacancy to tighten further, I think, by around 1.5% to 2%. This will drive the increase in rent expectations. On to the next slide. Total new supply is estimated at about 3.7 million square feet over from now until 2024. That's equivalent to 1.2 million square feet per year. That's 13% lower than the 10-year historical average of 1.4 million square feet in terms of gross completions. 35% of the new supply pipeline is located within the CBD. Now, supply is going to be further tightened by the redevelopment of older offices and also labor scarcity that will delay the upcoming completion timelines. We have Keppel Towers, 500,000 square feet that probably will complete in 2024. We then have Shaw Towers, Fuji Xerox Towers, Exeter Tower, only adding to supply from 2025 onwards. So if you look on the right-hand side, the office rental down cycle was short-lived. So Grade A core CBD rents growing 4% year-on-year to $10.80 per square foot per month in 2021, after declining 10% year-on-year in 2020. Now, that's less than the 15% decline in the period 2011 to 2013. That's also less than the 21% fall from 2015 to 2017. So we forecast Grade A rents to accelerate as they rise 7% year on year to $11.50 by the end of this year, or 12% over the next 2 years. Thanks, Ethan. I think you're on mute.
All right. Thanks, Su Tye, for sharing. Adrian, do you have any, outlook?
Yes. Just want to add on to Su Tye, right? Coincidentally, today, F1 has actually started open, their ticket sales for this year's F1. So I think, hospitality will definitely going to boost, the incoming or influx of, tourists coming to this event. And I think with that, if we are managed to control this outbreak, any COVID outbreak within Singapore after the events, this gives us a bit of slowing, growing kind of steps to welcome more tourists and also for us to travel. So I think tourism, with all these events lining up, would definitely help us to get back into habit of traveling again. Right. I just want to take a step back, and share our house view in terms of how the Singapore economic outlook would definitely be for 2022, right? So I think, just to echo Su Tye, right, is that, you have stated so many classic examples of how, with different sectors in the REITs, would definitely, will benefit from the reopening stories. But on the flip side, we do see some clouds gathering, geopolitical kind of clouding outlook kind of thing. So let's look at Singapore's GDP growth expectation now. Last year, we have a GDP growth of 7.9. That is after, much support from, global governments to prop up the economy, right? So this year going forward in 2022, our government came out and said that our expectation, GDP growth is about 4%. Now, 4% is actually lower than 7.9, but do keep in mind that's actually in line with the last periods from 2011 to 2018. That's actually our average GDP target growth. So, our government has actually felt that, our economy is actually, comfortable enough to reach that target again going forward. And then, we know that right now, persistent interest rates in US and stuff like that, and the slowing economy in China itself, right? These are two, mega storms going on both sides. Now, we believe that the sweet spot will probably in ASEAN, and we believe the ASEAN growth likely to accelerate upon the reopening itself, right? Economic recovery for 2021 in the ASEAN region has been very narrowed. Right, for this year onwards, we believe that recovery is definitely going to broaden as we shift towards the endemic phase right now. And like you said, Su Tye, mobility and travel-related flows are definitely going to improve from now on. I think the worst is behind us already. Right, so going forward, like I say, the reopening is well underway. Right, 75% workforce can now return to office. Right, definitely going to benefit the office rentals. Right. 10 is able to dine out from 5, right? The job market, the hiring market right now is actually pretty robust. We could see that, the wage growth for the middle class has actually returned 3.2% for this year expected versus 2020 where there's a pandemic, a wage reduction of 0.6%. So we believe that right now the job market is very strong. Now, on the flip side, inflation remained persistently very high. Last night, we have the US CPI numbers came in at very, very high, and that actually provides a foundation for US to have actually more room to actually wants to hike interest rates, right? So we believe inflation is expected to reach about 3.4% for this year, but that would actually reduce to about 2% from 2023 onwards, going forward, right? Now, on the currency side, I think tomorrow, right, MAS is expected to, we believe MAS is going to tighten its policy tomorrow announcement, right? So this, with the tightening, definitely US Sing dollars will definitely appreciate, and this appreciation definitely boosts for demand for yield assets such as REITs itself. So this is actually my 2 cents worth just to add on to Su Tye. Yes.
Right. Thanks, Adrian, for sharing. So I think, talking about inflation, we are, expected, the Federal Reserve has really given hints that we are going to have close to 7 rate hikes this year, and the next rate hike is expected to be 0.5%, right? So I think the key question here is how far does the inflationary environment how far would it affect the REITs?
Thanks, Ethan. So I think interest rate expectations, first of all, I think are key risks for the sector. So I think the recent US Fed comments suggest rate rises continuing on its trajectory, but it will remain in terms of an approach, very dynamic. So on our side, our fixed income team sees 10-year bond yields reaching 1.9% by the end of this year, and to peak at 2.25% in this cycle. That's whether the Fed hikes rates at a measured or whether they hike rates at a faster pace in the next 12 to 18 months. I wanted to show you on the slides that the REITs corrected sharply. That's on the right-hand side at 20% in 2015's rate hike cycle, and pulled back by a lesser 11% when the Fed hiked rates 3 times in 2017 to 2018, against more benign shifts in the yield curve. So they have corrected by, they corrected by up to 9% from the recent 2021 November peak, but they have also retraced this by 6% since then. So all said, we think that volatility will stay. And it's also an understatement to say that there is significant market uncertainty. But if you look on the next page, you can see that the balance sheets are strong. And the REITs have also increased their fixed rate borrowings to an average of 72%. So we did a sensitivity analysis and highlight that every 50 basis points change in our interest cost assumptions will result in a 1 to 4% reduction in DPUs. We also did an analysis that shows that every 50 basis point increase in our discount rate would result in an average of 9% cut in our dividend discount model valuation for the REITs. On the next slide, you can see that the sector yield spread to the 10-year Singapore government bond stands at 3.6%. That's close to 1 standard deviation above the 5-year historical average. We think the impact of higher interest rates are largely priced in. If we look at where the large cap REITs are trading at on the right-hand side, then we can see that their valuations are undemanding. In particular, CICT is trading at above 5% FY22 dividend yield, which is at its 5-year historical average dividend yield. And organic growth is favorable. Plus, we expect catalysts from rising office rents, also catalysts from moderating retail rental reversions, and importantly, a very visible acquisition pipeline. A-REIT is trading close to 6% FY22 dividend yield, which is also at its 5-year historical average dividend yield. Similarly, the growth outlook is strong and is also backed by structural demand drivers. MCT trades at 5.5% dividend yield, which is above the 5% historical average. So on the next slide, then to address your question on inflation, on a total return basis, the REITs are trading at 6 to 9% dividend yield. We expect them to generate 2 to 3% DPU growth for retail, up to 7% DPU growth for office, between 2 to 6% growth for industrial, and then higher 8 to 25% for hospitality. That's because RevPARs are recovering from a low base. Thanks, Ethan.
All right. Perhaps you want to shed some eye on Europe as well.
Oh, yes. Sorry. I forgot about this. Okay. So I think the important thing is that we should be, as you know, the REITs themselves are, the thing that I want to caution on is that we should not forget about Europe, because in spite of Russia being just a very small proportion of GDP contribution, the Eurozone itself to Singapore's GDP is almost 8%. And if we look in terms of the exposure for the REITs, many of them have already started to anchor their assets there. For instance, you have some REITs that are pure European REITs. What we have there is iREIT Global. We also have Cromwell European REIT. We also have other large cap REITs like CICT that has exposure in Germany. They are probably going to add more. We also have a Ascendus REIT that has recently deployed capital into $1 billion portfolio of data centers. It's going to do more. So essentially, as a REIT investor, given the context and the backdrop that we are in right now, one needs to keep an eye on what's happening in Europe, because fundamentally there will be some trickle-down impact to occupancies, revenues, and of course DPUs.
Right. Okay. Right. So thank you, Su Tye, for sharing. I think for the audience, when we always talk about S-REITs, we put an S in front of the REITs, right? Because they are simply just listed in Singapore, but unbeknownst to many, they actually hold a lot of properties elsewhere, like Europe and US as well, right? So let's move on to the next question, right? With the confluence of these two macro events, one being the reopening, the other being inflation, right? So the questions on a lot of audiences' minds probably will be this, right? Which sectors will be better poised than others, right? And what are some of the upcoming trends for REITs and property developments? All right, Adrian.
Yes. Yep. So I mean, thank you for the question, Ethan. Yes, just to go back to the first question, right? When it comes to interest rate hike, you could see from the chart previously when March, when the US Fed says that, hey, I'm going to raise 25 basis points, 7 more to go to 2023, you could see that REITs price has actually rocketed off, bottom off, and that actually supports Su Tye's valuation, where REITs CICT is trading at a very high yield, because prior to the announcements, most of the REITs, at least about half of the REITs listed on Singapore Stock Exchange, are actually trading at 52-week low, and that's a result of a high yield. But once Fed has actually removed the uncertainty from the market, say that 25 basis points in March, 7 more to go until 2023, that helps the S-REITs in market in general with the bottom off, as we have actually been telling investors that once that would happen, REITs will definitely benefit from that, because uncertainty has been removed from the market. And to see that with the Fed rates high, definitely help the S-REITs markets, instead of common belief that interest rate hikes is going to affect S-REITs, REITs market in general. But you could see from the chart just now that with that announcement, it actually helped S-REITs itself, because it removed the uncertainty. Now back to this question, right? Which are the two, which are some of the sectors that are going to benefit from this reopening? Is actually industrial, right? Because it has very strong tailwind. Demand for logistics assets has been surging based on the four key trends, right? The rapid rise of e-commerce. If you look at the chart at the bottom left, you can see that the global e-commerce sales has actually grown exponentially, right? Next is actually, the inflation right now is actually due to supply chains kind of bottleneck. So we are looking to diversify, this kind of global supply chains stemming from the COVID-19 and, probably the ongoing US-China trade disputes and, with the Russian-Ukraine conflict as well. So all this, we are looking, the industry is definitely going to benefit from this diversification from the global supply chain, right? So back then was actually a shift from just in time to now manufacturing just in case kind of mindset right now for industrial. And then right now, of course, the urbanization and of course the growth in the middle class, as I mentioned, that the growth market right now, there's a wage growth. So this growth in middle class will definitely be one of the key supports as well for industrial property. So according to a recent JLL survey, that logistics shows that demand is overwhelming positive for industrial property. Expected growth is actually more than 5%, right, for the next 3 years. And of the survey, 28% expect significant growth of more than 20% for industrial. So this demand actually stem up from e-commerce, express, parcel delivery, healthcare and life sciences, construction and material sectors. So again, with more technologies being introduced into these industrial properties, right, with the smart technologies and use of automation and robotics in supply chain, that will actually cause tenants to be very sticky to these industrial properties, right? Next slide, please. Right, next strategy also to ride on industrial is definitely on technology is definitely the data centers. And data centers demand is actually likely to remain high for many years to come, right? It's driven by structural trends such as the big data, Internet of Things, 5G, cloud computing, right? Those apps that we use on the phone runs on cloud computing, and those cloud computing are being hosted on data centers. So data center REITs definitely is going to, the demand for these REITs is definitely going to be high for many years to come. This is actually supported by internet penetration rates, right? Southeast Asia was actually the internet usage was actually about 25% 5 years ago. Now, currently in this year, it's about 65%. So it's still behind, UK, US, which is about 90% internet penetration rate. So this actually provides, more potential of internet users going forward. Right, we could see a lot of there's actually very limited new supply due to right now government's need to actually balance the energy consumption that these data centers uses, right? So with limited new supplies, would definitely increase in terms of the capital values of these existing data centers that there's right now in the market. So investments demand for data centers assets to remain strong with a turnover of about we have seen a turnover about 1.8 billion for the first quarter of 2021. That's actually 80% of the full year of 2020. So we believe that cap rates will definitely continue to compress and the capital values will definitely rise for data centers. So these are two sectors that continue to benefit from it. Yep.
All right. Thanks, Adrian, for sharing. How about yourself, Su Tye?
So I think Adrian covered a lot of ground in terms of the new economy fundamentals, which I completely agree with, right? So there's a lot of detail there, but I wanted to answer this part on the trends that I see for REITs and then property development. So I want to focus on 3 of these. So I think Adrian's absolutely right. First, we expect REITs will continue their push into new economy. So industrial REITs in particular saw stronger contributions from their overseas properties, growth in assets under management or AUM underpinned by further concentration into new economy segments. So warehouses, data centers, business park space. They were 71% of the REITs total AUM in 2016. They are now 81% of the REITs total AUM. A-REIT added 2.1 billion Singapore dollars in acquisitions last year. It remains the largest owner of new economy AUM amongst its peers. You can see on the right-hand side. So in Singapore, IT or data centers, biomed, engineering occupiers accounted for over 60% of new demand by gross rental income for A-REIT last year. These new economy sector tenancies are almost 80% of gross revenue and growing. So they push vacancies to the tightest in the industrial space in 5 years and will support leasing efforts into the coming quarters. On the next slide, you can see that the occupancies have been improving and rental recovery, therefore, is underway. So rental reversions turned positive on an aggregate basis for Mapletree Industrial Trust for the first time in 5 years when they reported the results for the December 2021 quarter. Expansion demand from 3PLs, from e-commerce players, as Adrian mentioned just now, and then from food storage occupiers. They've contributed also to stronger leasing activity. They have kept warehouse occupancy stable at 90% in the fourth quarter of last year amid the higher new supply. So as of fourth quarter of last year, ground floor warehouse rents, they were $1.66. That's up 7% since the first quarter of 2020. And prime logistics rents are at $1.47. That's up 12% during the same period. Factory rents were up 1% quarter on quarter. On the next slide, on supply, I think the industrial sector should see a pickup in supply similar to 2013 to 2017 levels, but largely concentrated in multi-user and single-user factory space. If you look on the chart, you can see warehouse supply remaining very manageable. That's 4.2 million square feet this year. It moderates to 2.4 million next year, and then moderates further in 2024 compared to 4.6 million square feet per year in the last decade, or 4.1 million square feet per year in the last 5 years. So rents increased at 1.8% quarter on quarter in the fourth quarter of last year, and for the full year, it was up 6%. Demand for storage trickling down to second-tier warehouses from limited availability in prime logistics space, and we expect these to strengthen further with easing supply. However, we expect the pace of recovery to moderate this year, but it will remain ahead of factory rents. So on the right-hand side, you can see business park rents. The stronger recovery in office rents will therefore suggest a similar trajectory for business park rents. I think I want to talk about the second trend for us. On the next slide, you can see is that rents are on a rise and recovery well underway. So I talked in detail on the fundamentals of the different subsectors earlier. So these two slides, this one and the next one, will show the outlook for supply, outlook for occupancy, and importantly, the outlook on rents. So for retail, we forecast prime Orchard Road rents to climb by about 4% next year. This is after Orchard Road rents fell 8% in 2020. They fell another 4% last year. So the premium to suburban mall rents are now 13% compared to 30% at the peak. Suburban mall rents, they've been very resilient. They rose actually 2% last year. We will expect the rate of increase to moderate this and next year. On my forecast, about 1%. For office, we are projecting Grade A rents to end this year at $11.50, as I mentioned earlier, and then reach $12.20 by the end of 2023. This is an increase of 13%. So given the strength of demand and also the tightness of supply, I think risk is going to be on the upside. On the next slide, across the industrial subsector, logistics has been the strongest performer, and warehouse rents climbed 5% last year versus 3% for factory and business parks. Demand growth for warehouse very much intact, but we expect rents to ease a bit to about 2% this year and next year. And finally, at the bottom, hospitality. We expect occupancies to be around 80% this year. This is still below pre-COVID. Now, I mentioned just now, we don't have much visibility now. We will need to track the numbers in the coming months. So we are forecasting RevPAR to climb 13% this year, and then a stronger 17% in 2023. My sense is that risk could be on the upside as well. And then on the next slide, finally, perhaps the most powerful trend to have emerged in commercial real estate over the last decade has been the growing mandate for green buildings. So the greening of assets has now leapfrogged from obscurity to the top of agenda for investors and for landlords. So based on interviews and surveys from, I think, they compiled 334 of leading players in the real estate industry, the role of ESG factors are mandatory in driving investment decisions for 37 of these respondents. That is up from just a quarter last year. I think environmental action has therefore taken a center stage role last year. So if we look on the next slide, you can see many of the REITs have raised green or sustainable borrowings from refinancing of their loan books, while at the same time also increasing the green proportion of their portfolios. So leading the pack here is Manulife US REIT Must. As part of its green strategy, management announced an alignment to the sponsor's target to achieve net zero and an 80% reduction target in greenhouse gas emissions by 2050. They're also aiming to achieve a 100% green certified portfolio by 2030. So at the start of this year, they have already increased their green and sustainability linked loans to 45% of total debt. So across the sector, we will expect these numbers to rise in the near term. Thanks, Ethan.
Right, thanks Su Tye for sharing. I think it's very interesting to see that there's more mandate going forward for the S-REITs, right? So let's take a holistic look at the S-REITs as a sector, right? So we gotta take a look at the index, right? So let's take a look at the SGX IH S-REIT Leaders Index, right? Adrian, do you have any opinion on that?
Yes, we do have an ETF tracking this index. Now, the reason why we want to partner with IH to do this index is actually because of how it's actually being structured. And we definitely like the way that this index is actually being created. And we want the investors to have access to this. So what it does is actually just maybe, let me describe the index methodologies and some of the details of this index now. The index is called IH S-REITs Leaders Index. Leaders, this means that it's actually have to be large and mid cap. And how do we define large and mid cap? It's actually they have to be, have a free float criteria of half a billion or USD 500,000 free float market cap to be considered as a leader in terms of the REIT sector. So out of 42 names listed on Singapore Stock Exchange as REITs, we only allow the big boys into this index. So out of 42, 28 big boys are actually added into this index itself, right? Then there's also a liquidity selection criteria. It has to be actively traded. This means that a lot of investors, institutional retail investors, large corporations are actually trading this large and mid cap S-REITs, right? So to show that there's actually liquidity, there's actually people looking at these S-REITs itself, right? So it has to be we call it a daily traded velocity. There's a speed to it, to the liquidity to it of 0.1% or more, right? And I will share more in details of the liquidity adjusted kind of weighting to the index. This is a very special, very unique selling point of this index that we liked it very much, which I'll share more in details, right? We will actually be balancing based on this liquidity adjustment, right? Now, the cap for each REITs within this index is actually capped at 10%, right? We will rebalance, the index will actually rebalance this on a semi-annual basis. So in March and in September. Now, just to write on to, what's within this, what are some of the REIT sectors actually this index is tracking, right? About close to 50% is actually into the industrials and, warehouse and data centers, right? So that is actually tracking the new economy right now. There's 50% exposure. That means this index is tracking the right economy, new economy right now that actually came out from, that's actually spread out from the COVID-19. So it's very relevant, right? It also have about close to more than 15% and 20% into retail and office REITs as well. So again, just to write on Su Tye's outlook and our outlook of this reopening, this actually this index is actually very suitable to write out this reopening story, right? And Su Tye also did mention keeping an eye on the European. 88% of our GDP comes from European. And having said that, this index in terms of the geographical allocation, 64% is still having properties exposure in Singapore, but we have actually very diversified kind of allocation in terms of properties around the world, right? We have 9% into Europe. So actually there is a exposure to that part of the world, right? And the rest are actually made out of mainland China, Hong Kong, Japan, United States, and Australia. So this is actually why we like to do, we like this index so much. Next slide, please. Right. So again, just to emphasize on the large and mid caps, right? They possess the scale advantage. These big boys have the muscle to negotiate in terms of borrowing costs. And to acquire properties, right? They are actually backed by strong sponsors. That these strong sponsors are government-linked sponsors, which have access to better, newer quality and more dominant assets, around the world, right? So they are actually in the pole position to get these properties itself. And we show that we did a back testing of this large and mid cap S-REITs. and they perform so much better than the market and versus small caps REITs itself. If you look at the table on the right itself, the large and mid cap S-REITs in the quartile one, right, has actually better risk return profile when compared to the smaller S-REITs itself. In terms of historical return, annualized return, volatility, turnover is actually so far better than having exposure to small cap. Right, back to the importance of scaling up, right? You acquire property, you get a bigger market cap, you have more stock liquidity, you get better valuation to borrow better, to raise equity cheaply, right? Then you're able to actually acquire more property. So this is actually a virtuous cycle that large and mid cap S-REITs possess that small cap S-REITs do not. The next slide, please. Yeah. So again, just to summarize, most of these large and mid-cap S-REITs has very strong government-linked sponsors with an experienced manager, access to better quality, newer, well-located, dominant assets. With scale comes with efficiency in terms of operations itself, right? And with the bargaining power that they have, the bigger muscles in terms of bargaining power, they have the yield spread advantage. You're able to lower the cost of equities and debt. That in terms gives them better profitability, lower return hurdles to acquire more properties itself. So, with the interest rates hikes, that's actually where people were worried about the current leverage limit, right? Even though the limit has been increased from 45 to 50%, most of these large cap still within this headroom. So this means that they have more potential to borrow more, to go and have to acquire more properties. So they're actually in a very good spot right now. So right now, even though Singapore is actually about 64% kind of allocation in terms of geographical, but you could see the S-REITs are actually rushing overseas to acquire more properties itself. And large and mid caps are actually in the pole position to acquire, to compete globally for quality assets, to offer diversification in terms of geographical and sector exposure. Then that will actually help them to achieve greater liquidity and access to the wider pool of investors. So that's the beauty of large and mid-cap S-REITs, the leaders that we have within this index. The next slide, please. Right. So now we talk about the liquidity advantage. Now, comparing to some of the traditional indexes, right? The larger your market cap, the larger weighted you have, right? But this index is actually rebalanced based on a liquidity kind of selection criteria, right? Wherever it comes to rebalancing in March and September, we call it the liquidity enhancements, which is actually being performed, right? If you look at the table on the left, right, if you have been very lowly traded for the last in between the rebalancing, you have a smaller readjustment factor when it comes to rebalancing. And if you are very actively traded, in this case, a quartile, fourth quartile, you have a higher adjustment factor of 1. Least liquid, least adjustment. Very liquid, very liquid one has over the last 6 months have a higher readjustment. Right. So, for example, let's say Suntec REITs in the last rebalancing in September, right? Suntec REITs before September was actually have a very high trading velocity of 0.9%. That is actually 9 times higher than the 0.1 stipulated by the index itself. So it falls into the very liquid one, and they have a higher readjustment factors. So before that, the weight of Suntec REIT within the index is actually 2.88, got bumped up by 1.35% to reach a rate of 4.23. CICT, unfortunately, was actually actively traded, but hit the 10% cap rate. So there's actually nothing much to do for us, right? Capital DC rate, right? DC, the new economy, has been actively traded. So this means has been actively traded. Maple Logistics, Capital REITs, these are actually some of the, the REITs has been actively traded. They got actually readjusted higher, right? So Manulife, MUST was actually not very actively traded. That was actually being pared down in terms of their weightage from over 2% to less than 1% at the rebalancing. So what this does is actually comparing to the traditional market cap kind of weighting index, right? This helps the index to rebalance to the actively very liquid traded S-REITs. With these activities going forward, right? This shows that there are actually fund flows. They're actually attracting investors attention, right? Or based on the trend. This also maybe could be a sector rotation going forward. So this helped the index to be very robust, to track, the relevant sectors that actually better represent the current market situation. So this is why this is so important for investors to have this, because it's actually it's a very smart kind of index rebalancing itself. Yes.
All right, thanks, Adrian. So I think a lot of investors are actually, the next thing they want to know is the yield. Let's dive straight down to the yield, right, of the index.
Yep.
Okay.
Yes, so I think S-REITs, the index actually offer the highest yield versus other yield options that we have, right? It's forecasted that this index, the gross yield by Bloomberg, is actually about 5.3% for this year, right? That is actually 130 basis points outperformance for the STI index, which is about 4%, right? And if you compare it to other yielding products like the MAS, our 10-year government bond outperformance in terms of yield to about 200%. Right, if you talk about core inflation, it's expected to about 2.2% for this year, right? There's outperformance as well. It beat inflation, right? And fixed deposit 0.8%. So there's about 450 basis points outperformance. So that's the reason why REITs has been a most preferred investment yielding product that most of the investors are going for. The next slide, please. Right. So again, just to, Su Tye has actually laid the groundwork for me perfectly, right? Rental yield is definitely going up. And rent is actually a composition of the consumer price index, a very popular index to track inflation. So if higher rental means higher CPI, right? And this means that higher rental means higher distribution to be given out to the REITs holder. So definitely that will definitely helps investors who bought into REITs itself. And according to the Bloomberg estimates, the dividend yield is expected to rise in the next 2 years, much higher than the Singapore inflation rate. Now, this is actually based on Bloomberg consensus and estimates. 2022 full year, 5.5% gross, and full year 2023, a 5.8% dividend growth, dividend yield for the IHS Leaders Index. So again, S-REITs definitely potentially is a very good hedge against inflation risk. Next slide, please. Right, so a bit more of my ETF, just to explain more. So we track the IHS REIT Leaders Index. We use a full replication strategies. That means we do not use any engineered derivatives or swaps. We buy the underlying S-REITs itself. And due to this, it's actually an excluded investment product, means an EIP product. Anyone from the streets can just invest into this product without declaring their education status or trading experience. You could just click on the button, buy through Maybank, Kiming, yes, into this ETF, right? Now, there are two currencies being traded on the Singapore Exchange, right? With a ticker code of SRT, that's actually the Sing denominated ETF, right? If you have US dollars and you want to buy into this, you can actually buy into the ticker code SRU, right? However, you do take note that both of these are fungible. What it means is actually if you could buy into a Sing dollars, and it should be that you have need for US dollars, you could sell into the US dollars class. Vice versa, you could buy with US dollars and sell into a Sing class and get back Sing dollars. So they are both fungible, right? And with we are committed to give out our dividends semi-annually, and we give out in US dollars, Sing dollars. Now, the beauty of this ETF, right? The beauty of this ETF is actually we cap our total expense ratio of this ETF at 0.6%. That means that, for investors holding this ETF, that the maximum cost to you is 0.6%. Anything more, CSOP will bear the cost. It will not be passed on to you, right? We are not ComfortDelGro, right? Just no pun intended. Yes, we will absorb the additional cost to you. It is just 0.6% cap for holding on to this ETF. Yes, thank you. Yep.
All right, thanks Adrian for sharing. So I think we are near the end of the webinar, right? So let's move on to, the key takeaways, right? Su Tye, I probably, get your opinion on this. What's one thing that, if the audience were to log in right now at this point in time, what are the things that, they could take away from this?
Okay, thanks, Ethan. I think, REITs still are very liquid, investable asset class. I think the material that Adrian shared just now, very fundamental, that with that very comfortable spread above whether it's the bond yield, inflationary pressures. I think this is still a place where you can get a proper hedge. You have to be very selective. So for investors that want to look at it on a long-term basis, structural demand drivers are still going to benefit your new economy REITs. Therefore, your large cap industrial names will be top of mind for any REIT investor. Also, because we are in the reopening phase and with some more legs to go, then some of the other REITs that will give you very clear exposure will be CICT, Suntec, MCT, and then of course hospitality is another exposure, but I really want to say hospitality, the visibility is a little bit low. We can wait a little bit longer. So these are the preferences in terms of sectors. Yeah, thanks.
All right, thanks Su Tye. How about you, Adrian?
Yes, I mean, if you like whatever Su Tye has recommended, CICT, A-REITs, and whatever REITs that he has actually mentioned, you could actually buy all of them with just one trade with our ETF, right? Yes. So we have with this index and with this ETF, we are allowing the investors to exposure to invest into the large cap S-REITs, which offers investors, quality assets, very strong sponsors, and strong management in running those large cap S-REITs, riding onto their economy of scale, their growth, and the liquidity that they provide to investors. We also have exposure to the mid cap because they offer a higher stable dividend yield, stable cash flows, offers kind of sector diversification to the exposure and giving investors a better representation of the whole REITs itself. And if you funnel these two benefits together into our ETF, CSOP IHS REIT Leaders ETF, definitely a smarter way to build your real estate portfolio based on the following reasons, right? Cost, with one trade, you can buy, all the REITs that Su Tye has mentioned, right? And definitely tax efficiency, right? Any individual who buy into the ETF or the S-REIT or the REITs itself, right? There is no tax on your dividends, right? So it's actually a tax efficiency in that sense, right? Liquidity adjustments, again, just how I did mention, when it comes to rebalancing, we look at, which S-REITs has been actively traded, some of the actively traded, right? So actively traded means that, there's actually a sector rotation. There could be a new fund flows, and it could, that would definitely help the index to rebalance to the right sector to better represent the current economy itself. The attractive dividend yield, forecast again, the S-REITs Leaders Index by Bloomberg estimates full year 5.5, 5.8 for next year 2023. So very attractive dividend yield. Diversification in terms of geographical and sector allocation, very stable asset because these are large and mid caps S-REITs itself. Very low volatility, outperformance over the small cap S-REITs. Thank you.
All right. Thank you, Adrian, for sharing. I think another point that a lot of investors, especially REIT investors, they know, right? That is that if you buy individual REITs, sometimes, you have the corporate actions, your, rights issue, then you're going to back calculate what's the theoretical rights price and that kind of thing, or topping up, that kind of thing. So yes, if you were to get the ETF, it's all taken care of, right?
Yes, yeah. Yes. You're right.
So I think that is one of the beauties of an ETF, right? So I think audiences might...
Yes. Cap at 0.6% total expansion.
Awesome. Yes. Thank you so much. Okay, right now, for the audience, right, we're actually working with Maybank, right, to actually let you enjoy this current promotion, right? So enjoy 3 free trades up to $75 in the form of trading rebates when you enter the promo code CSOP1 on your account opening form when you open a Maybank trade cash or margin account with Maybank. All right. So of course, the promo code is only valid to the end of the month, right? Do take note of the promo code CSOP1. All right. So if you have any questions, please put it in the Q&A session below. Okay, let me take a look at the questions. Just give me a while. Let me power up the questions. Okay. Wait, give me a minute. Okay. Oops. Okay. Okay, there's a question. Okay, I think the questions by all the attendees, most of them have already been answered by Su Tye and Adrian, right?
Yep.
So maybe I will, pick one question that probably Mr. Anonymous attendee has attended the webinar late, right? So he's asking, right? How can S-REITs be a good hedge for inflation when the portfolio is full of hiking price property? Not sure whether it's relevant to the speakers, right? So I repeat again, how can S-REITs be a good hedge for inflation when portfolio is full with hiking price property or properties that hike in price, right? So, okay. So I think to give the audience a context, right? I think just now Adrian and Su Tye also mentioned, right? Of course, the index itself is actually tracking the top guys, basically, the big and the mid caps, right? So they are these guys, like Adrian mentioned, they are well poised in terms of their bargaining power to get better rates or to get better quality properties, right? So I think this part, to add on Adrian's presentation and Su Tye's presentation earlier, right? It's not per se that REITs itself will be a very, very, very good hedge. But ultimately, some of this, optimism, reopening, demand in data centers, demand in industrial properties, they are probably going to outpace inflation. Am I right to say that, Adrian and Su Tye?
Yes, yes. I definitely, even though we buy the property, right, we call the yield advantage, right? They could actually borrow to buy a property, right? And then, and right now the economy is recovering and growing. Definitely could pass on that as by hiking the rental up to the tenants. So that would definitely help. So to combat inflation, as I mentioned, rent is actually part of the composition to measure inflation, right? So inflation guard means that they have the power to increase the rental, and increase our rental means that they could actually use that rent to distribute out to units. To unit holders, because Singapore government or Singapore taxpayer says that 90% of this rental income has to be distributed to the unit shareholders. So that's how it's definitely going to be a good hedge against inflation in that sense. Yep.
Okay, I think we are a bit short on time. One other question, right? Okay, I'm not sure whether Su Tye knows this, right? Eunice is actually asking, can the promotion be for existing clients?
Okay, I'm so sorry. I should know, but I don't have the answer on that. You probably should just check with your broker. They will have all the details for you. I'm so sorry.
Okay, no worries, Su Tye, right? Eunice, you can actually check with your broker and probably drop them an email. Maybank's email is there. All right. So next question, one last question, right? So I think Mr. Anonymous attendee is asking, will the ETF issue rights? I think this is a
no, we don't.
question.
No, we don't. We just, most of our portfolio managers will take cue from the index provider, which is in this case would be IH. We will take cue from it. We will actually track the index passively, right? But we also will keep about, less than 1% of our dividends and also our cash, just in case, there's any time where there's a rights issue of the underlying S-REITs, we will actually have the ammunition to subscribe them without asking, investors to top up with cash itself. So we have actually some buffer there, right? When sometimes, in between distribution period, we actually still have dividends. We actually deploy those dividends to subscribe discounted S-REITs to get exposure to for the investors. That would definitely help in terms of helping in terms of getting the tracking error very close to the index itself. Yes.
I mean, just to add on, I mean, previously we also mentioned that, the beauty of the ETF is that, if you're investing in the ETF, you don't have to worry about all these rights issues or these corporate actions. Whether it is, are you having to top up or, having to exercise those rights, that kind of thing. So it's all been taken care of. I think that's the beauty of it. All right. So I think with that, we are 5 minutes behind time. I'd like to thank, Mr. Adrian and Su Tye for, being our special guest for this webinar. I hope all the attendees had key takeaways, right? So don't forget that the promotion for the Maybank account opening and trades is actually in the video replay, right? We'll show you the video replay on YouTube, right? So keep a lookout for that. All right, with that, I wish all our attendees and our special guests, thank you and have a great evening. Right?
Stay safe, everyone. Thank you. Good night.
All right, bye-bye.
Bye-bye.
Thank you. Bye-bye.